So the great thing about auto-enrollment is you don't have to do anything. You just get put in a pension when you start a job. If you're over the age of 22, then there's very often a waiting period of 3 months, but then your employer is obliged by law just to put you in a pension and start taking money out of your pay packet and putting his own money into the pension for you as well. So he'll put in 3% of your pay, gross pay. You'll put in 4% of your gross pay, and then the government will top it up with tax relief as well. So if you're a basic rate taxpayer, that's another 1%. So the default savings rate is 8% of your income. An important point to note here, without getting too far into the weeds on the technical details, the minimum that the employer can do is 3% of your pay and 4% of your pay based on a band of your earnings that ignores the first £6,000 of your income, qualifying earnings, right? So if you're a relatively low paid person on, say, £20,000 a year, that's £6,000 of your income that's getting ignored for pension savings purposes. So you're actually only paying in 8% of £14,000 a year, which means as a percentage of your overall income, you're probably only paying about 6% of your income into a pension. So that's just one thing to be aware of.
It's also for the higher earners. It's not their whole salary. So you only get an 8% of like that band.
It's
so
capped off at 50,000. Yeah, exactly. So many employers are more generous and they'll say, we'll do the calculation on 100% of your income, or we'll cap it out at £100,000 or whatever. So that's one thing it makes sense to look at, is what's the actual calculation basis you, my employer, are using to work out my pension contributions. But that auto-enrollment system means if you're in the qualifying band, as most people are, you will get put in a pension. You will have money going into a pension for you. Now, the risk with that, and we've seen research to show this is true, a lot of people then go, oh, I'm in a pension. Job done. I don't need to think about this anymore. Well, as we've already started to talk about, that's not necessarily the case. So then you need to look at exactly what terms you've been put into a pension on, and whether you can put more in or where your money's invested, because one of the characteristics of auto-enrollment is you get put into a default investment fund, and that may not be suitable for you. So don't stop there. Just because you're in a pension, that's a great start, but you need to ask some more questions.
Let's talk about the default funds. So just to explain that again to people, when you are put into a pension at work, you're auto-enrolled. If you're not picking a fund, you're being put into a fund. This is the default fund. And if we think of like a Goldilocks example, this fund has got to appeal to millions of people, because I think around 90%, Nest advertise that 99% of their customers are in the default fund. They have about 12 million customers, say 15, whatever. And they've got to create a fund that fits all of those people at once. It's like a one-size-fits-all fund, right? So that means it tends to be a bit more cautious, would you say?
Yeah. So, and interestingly, what Nest did with their default fund is they go in phases. So for the first 5 years, you're in a foundation stage, and they deliberately make that relatively low risk, because they worked out, and this is not necessarily a bad idea, that if people have been defaulted into a pension and then there's a stock market crash, and because it's 100% equity invested in shares, their money goes down, then people might look at that and go, oh my God, I've just been put into a pension and I've lost money. This is terrible.
I think it's a terrible idea. Right. Because I think they're trapped in that pension. They can't even choose to.
Right. So, but that was their logic. Yeah. And I'm not arguing with them about it. So they said, we'll do a foundation stage. Then in the middle bit, we'll do a growth stage when we go much more heavily into equities. And then we'll do a pre-retirement phase when we start to de-risk the fund.
15 years out.
Right. And then we'll do a post-retirement phase. Now, they've deliberately designed that default fund to be quite cautious. Nothing alarming will happen here. But in doing that, they've probably quite definitely sacrificed some of the potential upside in terms of the investment growth they could have achieved. So that's what they've done. That's not atypical. I mean, most default funds will do something similar to that, where they're designing a fund that is the least worst option for the most people, right? That does not necessarily mean it's the best option for you.
Yeah.
I mean, most people are risk averse, especially if they're not heavy investors. But when you say the growth stage and it goes a bit more heavily into equities, does it ever go 100% equities, or is it still
they can
quite
get close to? So, and it really just depends on which pension provider you're with. Actually, even which pension scheme you're in with that particular pension provider. So just to take one example at random, Aegon, big Scottish insurance company, they have two different types of workplace pension. And I won't get too far into the weeds on the differences between them. But one of them, the default fund, is 95% invested in equities, so pretty heavy. The other one's 75% invested in equities. Now, so I would encourage anyone listening or watching to this to say, okay, go and ask your employer, what default fund am I actually in? What is the investment composition of that fund? And then have a think about, well, Am I happy with that? If I'm young and I'm quite happy taking investment risk, and you should be when you're young, I think there's this problem with reckless conservatism where you deliberately avoid risk. No, take risk when you're young. The funds will go down. That's great. You buy cheaper units because they've gone down in price, so you can get more of them. And then when they go up again, this is an enterprise economy. We want growth over time, but it's a bumpy ride. So take that risk when you're young. Invest, I would say, 100% in equities. You've got to be comfortable with that. So you've got to ask yourself some questions whether you feel comfortable with this. But it's a pension. You're not going to see it for 20, 30, 40 years. To my eyes, it makes sense to do that. You'll get better returns in the long run. And you'll end up with a bigger pot. But that's not how the trustees of the pension schemes look at it. I use that phrase, least worst option for the most people. They're saying, we'll just come up with an average that we think is not going to alarm people. It's a fund that maybe 40-year-olds are in. Well, if you're 20, you've probably got a different perspective on risk compared to a 40-year-old. So,
yeah, I think this idea of risk, there's a quote that I like. It's the stock market is like someone riding up an escalator whilst playing with a yo-yo. Most people focus on the yo-yo when they should focus on the escalator.
Nice. Yeah, I like
so
that.
Risk, the risk you're talking about is short-term volatility, as in the fact that the price of your pension might drop in the short term. This is the yo-yo focus, right?
Yeah.
What you're actually saying is, so if you've got a long time line, you're riding the escalator up to the top. And we know over long periods of time, the stock market tends to just trend upwards. So you should want as much exposure to that as possible. But these pension companies have a different kind of motive in the sense of they're just trying to keep their broad customer base happy to stop them from panicking and running away. And they use words like risk, which I think no one explains. That sounds scary. Because do you want stable growth or do you want risk? Like, it's a horrible way of framing that kind of...
because risk means different things to different people, right?
Yeah.
So if you're in your 20s, risk sounds interesting
risky.
and exciting.
It just sounds risky.
Yeah, right. When you're 58, right? Risk. Well, I'm not sure I want risk at this point in my life because I want a bit more security. So, but the trustees of the pension scheme, they're also thinking about their own jobs and the fact that if they take a lot of risk and then the fund drops one year, and then they're a bit of an outlier. And the benefit consultants, the gatekeepers who decide which pension schemes get selected by employers, they might look at the performance of your pension scheme over the last year and say, well, that one hasn't done so well in the last year. Maybe, Mr. Employer, when you're picking a pension scheme, you shouldn't go with them, you should go with someone else. So that short-termism can drive business flows. So trustees might tend to cluster around a median. They'll all do roughly the same thing because none of them want to be an outlier. That's their motivation. That's their focus. You as an individual can say, well, that's great, but that's your default fund. I'm going to go and pick a different fund. And you talked about equities and the stock market. I would absolutely argue for most people in favor of a global stock market. Don't just invest in the UK because you're then betting on the UK being the most successful economy in the decades to come. And I would argue that's not necessarily a robust bet to make. So if you're investing in global stock markets, then you're getting exposure to the US and to Europe. And so
it's like Damien, it's like the Spider-Man meme, you two pointing at each other. Yeah. You're literally echoing what Damien says all the time.
Yeah. And it's nice that, credible people I say the same things.
This was a clip from our episode with pensions guru and general legend Tom McPhail. To watch the full episode, click right here.